Welcome to the Brew, the Wednesday edition. I'm your host, Lex. Today, we are going to have a look at some earnings plays using option strategies. There are many, so we're going to tackle a couple of them today, and then we'll get to some others in another episode. So let's get to it. We have a lot to go over, and that's the bell. The music stopped. I'm still doing it.
Hey, Lex.
I like the music. Music makes me happy. Hi, Mal. How are you?
Should we have some background music for the whole show, every show? Maybe
I was
like some
thinking about
elevator
that because
music?
it goes from music and then it goes right into a deadbeat silence of me doing this. And I'm thinking maybe we have a
Right.
little fade out during that part.
Let's do it. We're gonna
So
tweak that next time.
we're gonna work on that. Okay. So the reason I chose this topic today, it's earnings, is because we're in the earnings season, right? So there's tons of stuff that's coming out earnings wise. I just did a random search. I chose Meta for our stock we're going to look at today because I believe those earnings are coming out tomorrow. So there's all different ways to play earnings. And from the pro world, which I usually like to speak from, because that's my background, we did things, in certain ways. And we're going to go over a couple of those versions today. Okay. Now in the retail segment, you have to have a few more tools and a few more, weapons in your arsenal. But I think what we're going to talk about today will give folks a prep course and what to look for at least so that they can make a really good, intelligent trading decision with some good risk reward metrics. How's that sound?
I love it. This is
Do
gonna be
you
exciting.
really?
I
do you
do. I
really
love
love
earnings
it?
because I do. I'm a fundamental trader, so I like nice cash flows and strong balance sheets. And when you read these, or they really tell you everything in these. You can jump on the calls. You
Yeah.
can read
So maybe we'd make a good team because I don't like that.
Okay, perfect.
And I don't know how to read them. So if you could tell me how to read them, then maybe I could put the strategy together and we could make some money.
All right,
How's that
done.
sound?
I feel like this is a good recipe.
Let's do it. So let's go to the remarkable first. What do you say? Here's our earnings play recipe. Now, if you look at the numbers down the left side, I switched the order at the last minute. So they're not in chronological order per se, but we'll talk about them in numerical order and bounce around. Okay. Now, for an earnings play, you have an implied volatility situation with options. Okay. Now we're going to ultimately go to TradeHawk and look at that. But for right now, just know that's the case. And that's very important in your decision making. Okay. Secondly, there's a reward to risk ratio that you have to have a peek at too. So we'll talk about that in a sec. So let's go down the line. First thing is what I like to look for is right here. And Molly, this is where you come in. It's called directional bias. Do you, as an investor / trader, have a bias in the underlying stock we're looking at? And if so, it's important to ascertain that and let us know. Okay. If you're bullish, wonderful. If you're bearish, wonderful. If you're neutral, wonderful. There's strategies for everything. Okay. So if you can determine that, that's wonderful. If you don't have an idea, it gets a little trickier, but still doable. Okay. Makes sense so far?
We're attacking Meta today, correct?
This is Meta, right here.
Okay, got so it? just to do the anticipation for the earnings that come out tomorrow, they're expected EPS earnings per share is $3.57, up from $1.64 in the prior year quarter, and revenue is expected to be $33.6, up from $28.65 billion. So everything's looking up. They did that deal in June with the DOJ as far as the advertising. They're one of the biggest investors in AI, so it's probably a thumbs up. Again, how does your trade ripple into the world and affect supporting companies? How does it affect the world? So take that component in as well. Yeah.
Good. So that's where I need you to tell me which way we think we're going. So let's call this a bullish sort of outlook. Okay. Now look we could be wrong. We could have horrible numbers. We could be wrong, but we're bullish to start the game. So we're going to look for something that benefits to the upside with options. So that's the directional bias part. Number 2 is we need to determine what the expected move is of this underlying asset, in this case, Meta. So A, we're bullish. B, we need to find out what the move is expecting in the options market. And options are a great tarot card readers, however you say that. These options implied volatility levels give you a peek at what the option market makers and the professionals are expecting out of the move from Meta. The way we do that, and again, we'll look on TradeHawk in a second, but just generally speaking, is, and it's not the most precise mathematical methodology, but we take the at the money straddle in the month in question. In this case, it's the front month, or it's the October. It's the October 27th expiration. That's the closest one we have to the nearest expiration. To the nearest earnings release, which is tomorrow. So that would be October 27th, which is 3 days to go. Okay. So we're going to look at that at the money straddle. So I did a soft computation of what the at the money is. That's easy. I looked at the two markets, the call and the put. A straddle is buying or selling a call and the corresponding exact strike put. So it doesn't matter buying or selling. We're just using the math to see how much the move is expected. So this straddle,
and the difference between that and a strangle, for anyone
strangles use different strikes. So the call and the put are different strikes. The straddle is the same strike. Okay.
And is this for high volatility, or what kind of
environment? No, this is just the determining factor to find out what the move is expected. So when we add the call and put together, the call is, I'm going to round numbers up, and I'm looking at TradeHawk, but we'll get there in a second. $13 on the call, and let's call it $13.40 on the put. So 13 plus 13.40, 26.40. Agreed with that math? Agreed. So we have an expected move of $26.40 right now in time. Okay. What we do with that is, if you're downside, if you're bearish, you'd subtract 26.40 from the at the money price, which is 312.50. If you're bullish, you'd add it. So let's just do the adding part because we think we're bullish. 312.50 is the at the money plus 26.40 gives us a number of 338.90. Okay. There is no 338.90 strike. The closest one we have there is a 337.5, but that's lower than what our expected move is. So I'm going to pick on the 340 strike. Okay. That's what I'm going to choose. Is that okay?
I love it. That's great. Okay. And so, do we get a glimpse of the orange calculator? Or are you going to?
Yeah, it's very important. So it's not a great calculator, but every trader, especially they all have calculators. We do a lot of math in our heads, but we still use calculators. All right. So now on the remarkable, we're at 312.50 plus 26.40. I'm running out of remarkable room here. 338.90. We're going to call that 340. We're rounding up. Anytime you can go up higher, you're better off. Okay. So what this strike represents is, if you're doing a butterfly, for instance, that's where we're going to place our short strike. That's what we're expecting. Okay. If you're doing a calendar spread, which is a mixed month spread, we're going to place our short strike in the front month at that 340-ish level. Okay. So everything we do here with our strategy is going to pick on that 340 strike. We're going to beat it to death with a sale. Okay. So number 3, if we're going to do a calendar spread, we want to check on the implied volatility difference between the spot month, which is the closest month to the earnings, and the next one out. So in earnings, you get massive implied volatility spike in the nearest expiration to the earnings, and then it fades down very much in months after that. Okay. So you have the potential with a very low implied volatility in month 2 and beyond to buy something out there and sell very, very high volatility in the nearer term month, in the earnings month, let's say. Okay. And you can create time spreads and diagonals to do those sort of things as well for very cheap prices. So we'll look at that in a second on TradeHawk when we get done with our list here. Number 4, all these are very important. Number 4, I'm drawing on the screen. Here's my arrow. Look for great reward to risk ratios. What does that mean? What is your max profit divided by your max loss, or what it cost you to get into the trade? Okay. So we have a metric, at least I do, is I need something at least 3-1 or greater to consider the trade. Okay, now what does that mean? That means you can make $300 for every $100 you spend in your trade, in your position. So if I buy something for $100, $1, okay, and it has a max profit of 3, that meets the criteria. I'm looking for much bigger. I'd love to have much bigger, but I won't do it unless it's at least 3-1. Does that make sense?
Okay, and this is discipline you've built over years of a massive career, and so how does someone get to their parameters? Just quickly, how
you just copy
what
them
does
from
it just
me.
trial and error? Okay, model an expert. All right, model a pro.
Copy them of someone who's done it for 38 years or 37.
All right, write that number down. Write that ratio.
That number down, 3-1. Okay. There's other metrics too. We're not going to get into everything today, but we'll do it in another show because there's other sides of the short side where you don't get 3-1, but your probability of profitability is so massive that you can take that chance. Okay. And we'll talk about that in a different show. That's a little bit different spin on this. Okay. So that's number 4. Number 5, we always do risk-defined strategies. What does that mean? It has a max profit. It has a max loss, period. There's no infinity sign in anything we do on either the long side or the short side, especially the short side. So we do a risk-defined strategy. What are those? A butterfly has a risk-defined strategy. A broken wing butterfly has a risk-defined strategy, right? A time spread is risk-defined. A call credit spread, a put credit spread, anything that you don't have strapping short units in it, okay, is risk-defined. We're always looking for something that has that, okay, with our strategy, okay? Do you have a question about that?
Great. Stop loss orders, does that play in this at all?
That comes in after we figure out
where we're
the whole process here. Okay.
Okay.
So the remarkable is remarkable, right? Did you like that? I love that. It gets kind of messy though, because I'm in my trial. I mean, I love it though because it makes me feel like a mad scientist.
You're in a flight cockpit right there. You have 6 screens in front of you.
I do. I'm gonna share another. I'm gonna share another one. But so does this all make sense so far?
Really great. And this is really neat, the remarkable, because you can rewind, screenshot his page, and study it for later, including that ratio.
Yeah. So we'll talk about it. Yeah, we'll talk about it a good bit. Now, what I have up here is I have TradeHawk up here, and I've put together a few looks at some of these trades. Okay, and I want to make sure we go over things. Can you see my mouse on the screen?
Yes.
Okay.
Yeah.
So I've got Meta up here. This is the option chain. Calls are on the left, puts are on the right for some of our beginners. And it's very much an industry protocol. So if someone says, I like my puts on the left, say, then, go trade somewhere else. We like calls on the left, puts on the right. That's how the industry does it. But just as a note, just want to make that clear. That big orange band on the TradeHawk screen is the at the money. We automatically compute that, and it bounces around as the stock price changes. So that's where that at the money lies. Okay. So now I have a very good visual of where at the money is. You remember I said it was 312.50. We added 26. 40 to 312.50. And we got to 338.90, I think it was, right? So that's right around that. We're going to call it the 40 line is our interesting point. We're going to sell something on the 40. Okay. Now, remember, we want to look at implied volatility between 2 months to see if we're going to do a time spread or a butterfly. So what is our implied volatility in October, the earnings month? It's 115.66. Okay. See where my mouse is up there?
Right.
The next month is 71.19. That's a big difference. Okay. If you look out in time, that, as this gets muted and earnings plays aren't very interesting out here in time, look at the difference between a 31-day, which is 49.44, and a 38-day, which is 47.37. They're very close to one another. They're still tailing down, but they're close. This is 30-something points, 40 points different. So the likelihood is we can set up a calendar spread or a time spread where we sell the front month and buy the second month for our risk-defined strategy and have a very cheap number, especially if we're bullish, right? We said 340, and have a great play. So let's do it. So I'm going to sell the 340 call. I'm going to go into month 2, November, with the very much lower vol, even though it's still pretty high. Okay. and I'm going to buy the 340 call there, and I'm going to have a time spread. I call them time spreads. A lot of people refer to them as calendars. Okay. Now, my price for this trade, I'm going to do a 20 lot because I just like having lots of stuff on. So it's 135 is the cost of the spread. That's my maximum risk. Let's see what the maximum reward is. Okay, so I'm just clicking a button. Give it a second. So with my my investment, I've got a max profit of $22,678. Right? My cost for this trade is $2,700. I'm going to the orange calculator. 22,678 divided by 2,700 is 8.4, call it. That's way more than 3.0. That's what I want to see. I want to see 8.4. Yeah. Okay. This is a trade I'd consider doing for my bullish play in meta earnings. There's not much I can lose here. And the likelihood is if I do this trade and I'm wrong, I might be able to wiggle out of this trade for a profit or a break even nonetheless. If it goes down or it doesn't make the whole move, I might be able to wiggle out. When this earnings is announced tonight or whenever it is, this volatility, implied volatility in October is going to get crushed. So is November, but we have such a disparity that we're going to get more movement on the short side than we do on the long side, and we're going to get a good price. Now, what we can see here with the calculator in TradeHawk is we can play those games. I can change implied volatilities. You can see how this price moves. So remember 105.42 and 66.32. I know you got that already. We're going to move along. So in reality, if these two were as close to each other as they should be, this should be up in, let's say, a 104 is close enough. Okay. So if I type in 104 for the second, look what the price of my spread should be. 818. It's 135. That's how much edge we have in this, right? That's a lot of edge. So let's go back down to 66.32. I know you didn't remember those, Mo. Maybe you did.
So I never use my glasses, so it's a full blur here.
Right. So now we're back to 135. Now let's see what's going to happen in reality. When the earnings come out tomorrow, this isn't going up to 104. That doesn't make any sense. What makes sense is to the high implied volatility to come back down to reality, to where everything else is. So my feeling is that this is going to be, it could be in the 60s. I'm just going to make it up, but it's going to be way lower. So if it comes down to 60, look at the price of the spread that we own at $1.35. It's 440, 427 now. We've made, 3.5 times our money on this one. Right. The likelihood is this thing probably comes down at some point to, it looks like it's around a 45, let's say. And then this will probably come down to a 43. So this is going to hurt us here, right? So, you can get crazy things that happen like that. But don't forget, that's the price. It's the same prices we have here without the move. This does better to the upside. Okay, so watch what happens. This is the likelihood of the volatility. Okay, and we're wrong. We didn't get our move. I'm going to make our move happen now. I'm going to say it got up to 338. Let's see what the spread looks like now. Oh, 421. We go from 135 to 421, assuming we're right on our direction. So even with volatility change, correct on direction, we have a home run. If we don't get the direction right, and it's unchanged, which I showed before, we're break even. Pretty good. It's amazing, right?
And that's where the addictive quality of options comes in. Be careful, you'll catch the bug.
You'll catch the bug. And look, I know for a beginner, listen to me ramble on here this fast. I totally understand it's hard to get. But you got to follow those steps, and you have to put on something that has a very, very low risk reward. Here's spread number 2. Okay, so that was a mixed month spread. We're going to do a spread in the same month now. We're going to use that high volatility to construct this spread. Now, I will tell you that when implied volatility is high, butterflies are cheap. Okay, so what I'm going to propose is a broken wing butterfly because we're bullish. Okay, now look at it. If you're not bullish, all bets are off here. But we're going to do a butterfly to the upside. Where are we placing the short strike? At the top of that 2640 move, which we've computed to be about 340. We're giving ourselves a little bit more room above 338.90. So 340 is going to be my short. That's the option I'm going to sell. In a butterfly, we have a ratio of 1 to 2 to 1. Again, no straggling units. We have 2 longs and we have one short in the middle. Okay. Now, they don't have to be uniform. So I'm going to do what we call a broken wing butterfly. What does that mean? That means I have a directional bias on my butterfly. And one of the two spreads that I compose has a wider strike path than the other one. So they're not uniform. It's not like one strike, then 5 up, and then 5 more, and it's uniform. That's a uniform butterfly. This is a broken wing. So it could be 10 in the bottom and 5 in the top. And we're going to construct that one and show you what it looks like. Okay. So let's do the 330. Remember, 340 is where I need my short, and that's 2 of them I got to sell. Okay, and I'm only going to go up 5 strikes on my last protective long. Okay, and this is the broken wing part. I've got 10 strikes or 10 points here, 330 to 340, and I've only got 5 here. So it's what we call a broken wing. Okay, and I've graphed this for us, so we're going to take a peek at it real quick. So here's that broken wing butterfly. This is a beautiful spread, right? 335, 345, 350, 1/2/1 ratio. Okay, so you can see flat lines all the way up. You can see flat lines all the way down. I have a defined risk strategy. I can only lose so much. What is my maximum loss? I'm going to hit the dollar sign and we're going to talk about it. So the cost is $1.39 for this spread, which is very cheap. I can lose for every one lot $139.50. Okay. My max profit is $860.50. Okay. And oops, I'm using the canubulator divided by the 139.50. I'm trying to get it exact. 6.16 reward to risk. Okay, it's not 8 like the other one, but it's pretty good. It's well above 3, almost twice as much. It's twice as much, which is great. So now I've got another risk defined spread. Here's the beauty of this one, though. This is a little different. If I'm right and get my move up toward the 340 area, my spread's going to do great. Okay, volatility is going to get hammered. Beautiful for this trade. I'm going to probably take it off before the day's over. I'm going to make a lot of money and move on to cocktail hour or something. The nice thing about this broken wing is you've got an upside that if you're wrong to the upside and it blasts through everything, you have a locked in profit because you have 2 different spreads. One's a $10 spread and one's a $5. You're long the 10, short the 5. So 10's better than 5. And if it goes way, way up, your 10's going to do $5 better than your $5 one is going to hurt you, right? So I can make $5 more, less what I pay for this entire package, which is that $1.39. So that's how we get to that number. Okay, so it's beautiful with this. Does it make sense?
Yeah, and butterflies are your go-to. You love butterflies. Is that correct?
Love butterflies.
Yeah.
Yeah. So all this max profit is my $10 max profit less the $139 I'm paying for this thing. So up here, I can make that $10, and you take away with the $139 I paid for it, and I get to that 88.60, 61 thereabouts. There's some rounding involved. So these 2 spreads are great. I love them both. Again, very directional. And we've shown that in the first one, which is this calendar spread, okay, that's this one, that even with an unchanged move in meta tomorrow, it doesn't go up. It's not the bullish move we were expecting. We still break even. We might be able to wiggle out of that trade for a break even a small profit. You know, obviously where that trade hurts us is a big downside move. It's so far away from our 340 strike. That one we could get hurt on. Okay, but the whole point of this is that you have to have some ability to assess your feelings on directional on this and make an intelligent plays. These 2 plays are very intelligent, great reward to risk, very low capital usage whatsoever. You've got a great chance of making some good money and wiggling out if you're wrong. And those are the kind of things I love to have on, especially during the earnings cycle. So,
bravo!
I talk so much.
Well
I got to.
Well done.
So yeah, these are good little tidbits. I think they're really helpful. Go through the steps. And Mal, I don't know how people get a hold of us, but if you send us a little note in YouTube in the comments, say, I'd love to have your steps. I'll make them really neat and clean, and we'll send them out to people if they want that.
Absolutely. Yeah. Ask comments below, ask questions. If you're in a position you're stuck, you can ask Lex for what would he do. He doesn't give advice, but he can tell you what he would do in his situation.
Yep, absolutely. Love doing it. So don't forget, this is the Brew. Options Brew TV is our YouTube. Please subscribe if you like this sort of content. We talk about these kind of things among many others. We always have guests on the show. So it's a great place to go. Join the hub.tradier.com. That's where all of this is compiled. Give us a like, give us a subscribe. We love that sort of thing. What else? What am I missing, Mal?
Oh boy, we've got a really great on Friday. We've had Paulina coming up. We have Trader's Edge tomorrow. Really good stuff. Or actually today, Trader's Edge, and we have Bubba is doing some morning plays, and we've got Brian. And so if you go onto the hub, you can see all of our contributors. There's great articles in there. Trader's Workshop with Lex is on Thursday for the experts. So jump in on that. Even if you're just beginning, sign into that, watch that, because it soaks in, and if you stick with it for a month, all of a sudden things start to make sense. Yep. So join anyway, even if you're a beginner.
Yeah, we do beginning things too. We have a beginning series we started. We'll pick that up again. But since it's earnings season, there's some good things around earnings. So we'll keep a report on this, see how we do it. Look at, obviously, if we're wrong on direction, we're going to probably take a bit of a loss, but not too bad. It won't be too bad. So I love trades like this, right? I love it. I love it. All right, good. Think like a pro, trade like a pro, discipline. That is the creed.
Words to live by.
Trading options. That's right. All right. I'll see you Friday.
All right. And check out our Tradier Rundown.
Check out the Tradier Rundown. We'll have that out soon. Ding. See you, Ma.
Bye.